Hey folks, Dan Frio here with your daily report to let you guys know what the economics behind real estate is and what news events are coming up today that might play a role in real estate. So I do this video on a daily basis to keep you guys informed what's going on with the economics, the interest rates, different mortgage programs, and maybe some specials that we might have to help you guys make home ownership a reality. So the first thing you're seeing right here, the top 6 products people use when they're buying or refinancing a house, and mortgage rates are spiking up again. But I try to dig into this, and there's really no reason other than a flood of corporate bonds hitting the market this week that really should be playing havoc on mortgage rates. But I have an interesting video that I want to go over with you guys here shortly, and it's Fed Chairman Waller. He sits on the Federal Reserve, and it's basically a candid interview that he had with CNBC. We're going to go over that here shortly and kind of break down what he's saying, and basically what he's telling us right now is, you know, we can, as the Fed, we can actually afford to sit back right now and pause. So it's an interesting interview, and I'll get to that in a minute. So let's figure out why mortgage rates are doing what they're doing. So to do that, we go over to the economic calendar that we have for the week. You see, on Monday, there was a holiday. Tuesday, there was actually no data out there. And then on Wednesday, we have some data trickling in, and Thursday, and that's it for the week, folks. So let's go through the data that we had so far this week. We had manufacturing numbers and service numbers. They actually came in basically in line. They might be one tick or, 1.5% off of what was expected. But then one thing that I thought was going to really kind of shock the market this morning was the initial jobless claims. So why? Well, you might be saying, Dan, well, those numbers look actually better than expected. Well, they are. So the initial jobless claims, the last reading came out at 229,000. That means 229,000 people filed for the first time that they lost a job. Well, analysts that were expecting that to raise a little bit to 234,000. Well, it actually went down a little bit to 216,000. So that means less people got laid off, and then the Federal Reserve might be saying, okay, the job strength in the market is still there. So, but I don't think this number is big enough that should cause some havoc in the market. So without further ado, let's get over to the CNBC. Let's see how the stock market is reacting to a lot of this stuff. You can see NASDAQ just popped up on the screen. NASDAQ falls for the 4th straight day as Wall Street frets over potential higher interest rates. So in our next video, we're going to go over what Waller says, and he sits on the Federal Reserve. So let's get over to it.
Yeah, we can only hope. Andrew, joining us now in an exclusive interview is Federal Reserve Governor Christopher Waller. Governor Waller, thank you for joining us this morning. It's really a great time to have you because we had all that data last week. We had the jobs data and we had the PCE inflation data. I wonder if you've been thinking about it and how you react to what's happening. Is it going along with your forecast?
Yeah, thanks, Steve, for having me on. Yeah, that was a hell of a good week of data we got last week. And the key thing out of it is it's going to allow us to proceed carefully, as Chair Powell said at Jackson Hole.
Proceed carefully.
There's nothing that is saying we need to do anything imminent anytime soon, so we can just sit there, wait for the data, see if things continue. The biggest.
Did you hear what he said? We can sit there and wait. Okay, so then that's basically couples with the data that we have from the CME telling us the Federal Reserve isn't expected to raise rates anytime soon, but the markets are going to spin this and pull out the data that they want to basically give you shock and awe. So let's continue with the interview.
Biggest thing is just inflation. We got 2 good reports in a row. Can wait and see what a third one looks like and see whether this low inflation is a trend or it was just an outlier or a fluke.
When you say low inflation, when I looked at some of the things that we know that the chair looks at, I know you do too, which is that PCE core, taking out housing, it actually went up. What about it made you feel comfortable?
Okay, so I apologize for continuing to interrupt this interview, but what they talked about is PCE and core PCE. So let me explain that to you. With PCE, that's the main measurement that the Federal Reserve uses when they're talking about inflation. What the core piece of this is what they do is they strip out, they pull out the numbers for food and energy. Why? Because they're so volatile, and he's going to say that here in a minute. So I am very much concerned about oil prices right now. They went from about $65 a barrel to now about $85 a barrel. That's going to include, increase some of the inflation numbers that we're going to see. Why? Well, unfortunately, oil is basically the blood of our economy. It makes everything run. But let's get back to the interview.
Well, the thing that really drove it were non-market services, and those things can be volatile. They're not really a clear indication what market prices are. So I typically don't like to throw things out, but in general, this time it clearly was something that was a bit odd, and we'll see if this continues.
Meanwhile, the unemployment rate went up. Is that a source of concern for you? It was up by 0.3. Is this the beginning of a gathering weakness in the job market, do you think?
Well, the data last week clearly showed the job market is starting to soften, but the unemployment rate, if I remember correctly, last August was 3.7. So you're roughly where you were a year ago. So we're not seeing a big movement. And some of the increase was just an increase in labor force participation. As more people entered the labor market and are looking for jobs, jobs are getting a little tougher to find. It's not surprising the unemployment rate went up a couple of tenths. But again, it's really not much different than it was a year ago.
Is all of this in line with an outlook that you have for a soft landing, or do you still see a threat of a recession to the U.S. economy?
Well, the way the data is coming in, it's looking pretty good. But recessions often are caused by shocks that just come out of nowhere and hit the economy. So that can always happen. And that's why they're shocks. We can't really predict them. But the way the data is coming in right now, it's looking pretty good that if we can keep inflation coming down for the next few months on trend at like 0.2 a month, we're in pretty good condition.
So can you stop raising rates now, or do you still need to hike
Moneyball.
more?
Well, that depends on the data. I mean, we have to wait and see if this inflation trend is continuing. We've been burned twice before. In 2021, we saw it coming down, and then it shot up. The end of 2022, we saw it coming down. That all got revised away. So I want to be very careful about saying we've kind of done the job in inflation until we see a couple of months continuing along this trajectory before I say we're done doing anything.
But would you say the risks are now evenly balanced between doing too much by the Federal Reserve or doing too little?
Yeah, I'd say they are more. I don't think one more hike would necessarily throw the economy into a recession if we did feel we needed to do one. But at the same time, like I said, the job market is still pretty strong. I mean, these numbers are still near historic lows at 3.8% unemployment. So it's not obvious that we're in real danger of doing a lot of damage to the job market, even if we raise rates one more time.
Chris, let's talk about the issue of monetary policy lags. This is something that some folks have said is a big deal, and it's there's yet to come a wave of negative impact on the economy from the big shocks of interest rate hikes you had. But you've had the opinion that the lags are here now, that in this economy with a big increase of interest rates, the way the Fed did it, that there is not much of a lag to the economy. And that kind of puts you a little bit at odds with Fed Chair Powell, who said recently that there could be significant lags yet to come.
Well, this is a tricky problem because there's never an exact number on when the lags tend to hit. And I think, as I gave a speech back in July, that I think the lags are shorter. They're still there, but they're not like, we don't have to wait 2 years for this stuff to start impacting on the economy. And we're seeing it now, as far as I'm concerned. You're starting to see the economy slow down. We're seeing inflation coming down. And it's really been just a little over a year that we've done a lot of large hikes. So I think we're already seeing the impact. The other thing that people seem to have this idea that long and variable lags means there's this cliff effect, what I call the Wile E. Coyote moment, where the economy's going long and then it just collapses. That's not how these typical lags.
Yeah.
They start having an effect, they build up, and then they eventually fade away. There's none of this cliff effect that everybody keeps talking about.
Great interview. So let's break it down. Does he sound completely negative, like they're going to continue to raise rates higher and higher and higher? What I got out of this, and a lot of people didn't see this interview, is what I got out of this is he's saying, we're pretty much there right now. Other than the job market coming down, inflation's come down quite a bit. We're now in the area where we can probably just wait and pause and see how all this comes into effect. Yes, it is data driven, and that's why I do this report on a daily basis to keep you guys informed on what's going on. So next thing is I want to talk about is briefly, we wonder why we have inflation. We wonder why we have this national debt hanging over our heads and all this other stuff. Now, I'm not against Ukraine and helping others when they're down, but when we're, as an economy, we're really, really struggling, and the administration comes out and now they're giving another $1 billion to Ukraine as an aid package when we already have a huge deficit. And what you're also going to be starting to hear is we're in another environment now where the Federal Reserve or federal government might have to shut down because they're running out of money, a debt ceiling. So I just wanted to bring this part up because we're running into a debt ceiling issue coming up very, very soon. And to be just printing money and sending it all over the world is pretty much counterintuitive, I guess, is the best way to put it. So without further ado, let's get over to, based on this information, what do we think the Federal Reserve is going to do at the next meeting? So what we do is we go over to the Chicago Mercantile Exchange right through here and we look at the Fed Watch tool. And based on the information that we had in the last couple days, what's the likelihood that the Federal Reserve will change the target rate at the next FOMC meeting? Well, let's check it out. Right now, the federal funds rate is 5.25 to 5.5. So we are right in this range right through here where you can see it blue at 91%. So that the next meeting, they're saying the probability that the Federal Reserve will not do anything with federal funds rate is 91% probability that they will stay with it where rates are right now. And then the probability still stays at a little over 50% through the rest of the year. And then the interesting thing is then in 2024, even the Federal Reserve, based on their dot plot, is telling us they're going to start reducing rates. And the dot plot is right here. If you want to learn more about the dot plot, check out some of my other videos because I usually talk about this on a daily basis as well. So let's get back over to where mortgage rates are right now. These, like I said, these are the top 6 products people use when they're buying or refinancing a property. So the scenario behind these rates right now, here's what it is. So if you're like, Dan, my rate is much worse than that, well, I'd love for you to reach out to us. But you might say, Dan, my rate's a little bit better than that. Well, kudos to you because this is the national average. So what this scenario looks like is if you're a first-time home buyer buying a primary home and it's a single family home, those 3 things. And the next thing is you have a 740 credit score and you're putting down 20%. Now you do not need to put down 20%. Our average person, when they're buying a house, they put down 5%. So you don't need 20%, but that's the scenario behind these rates. So how do you find out what you qualify for or what kind of rate you can get? Or can you even qualify for a house in this market? Well, the easiest way to do this is please don't disqualify yourself. Please talk to a mortgage advisor. So I would love to help you. I'm licensed in all 50 states as well as Puerto Rico. So if you'd like to reach out to me, I would love to help. 3 easy ways to do this. First, you can click the Apply Now button. What it's going to do is ask you a few questions so we can get familiarized with your scenario. And so when we do schedule a consultation with you or review your application, we'll know a little bit about you. But if you're like, Dan, I really would love to talk to somebody or reach out to somebody directly, well, it's easy to do. Just scroll down to the bottom of the website and right through here, you can give us a call at 844-775-LOAN. That's 844-775-5626. Or you can even just shoot me an email at dan@therateupdate.com. Thanks so much for watching, guys. God bless. And if you haven't subscribed to my channel yet and you find value, please don't forget to subscribe down below. Take care. See you tomorrow. Bye-bye.